One of the important matters which I mentioned in the first part of this lecture series on Introduction to Accounting is the 4 phases of the accounting process, enumerated in the definition of accounting given by the Committee on Accounting Terminology of the American Institute of Certified Public Accountants. Because these are phases or steps, they must be performed in proper order. Recording must be done first, followed by classifying, then summarizing, and finally interpreting. The recording of transactions is done in a book called the journal. That's why recording is also known as journalization or journalizing. Classifying is the sorting or grouping together of similar items in a book called the ledger. The term posting is commonly used to refer to this step. Summarizing basically refers to the preparation of financial statements, while interpreting is the evaluation or analysis of those financial statements. Meaning to say, the accounting work does not end with the preparation of financial statements. Those financial statements must be studied, evaluated, or analyzed in order for the users or stakeholders to be able to come up with sound economic decisions. As a matter of fact, if you remember, the idea or goal of making economic decisions is expressly mentioned in 2 other definitions of accounting, which I discussed in the previous video. Now, what are those financial statements? Financial statements are the means by which the information accumulated in financial accounting is periodically communicated to the users. Financial statements are the means or the way, the manner or the method by which the information accumulated or gathered or collected in financial accounting is periodically communicated to the users. The term periodically means at regularly occurring time intervals. In other words, financial statements must be prepared and made available to stakeholders not just whenever the accountant or the company wants, but regularly or periodically. And speaking of periodically, the basic accounting period is 1 year, which essentially means that financial statements must be prepared at least once a year. May an entity prepare financial statements every week? Yes. May an entity prepare financial statements every month? Yes. How about every 3 months or quarterly? Yes. How about preparing financial statements semi-annually or every 6 months? Yes, definitely. How about only once a year? Yes. May the entity prepare financial statements once every 18 months or every 2 years? No, because the basic accounting period is 1 year. Financial statements must be prepared at the very least once a year. Please keep that in mind. That is quite important, even for succeeding topics. There are 5 financial statements. The first is the statement of financial position or balance sheet. Statement of financial position is actually a newer term, as the name balance sheet has been used even long before we were born. The statement of financial position shows the financial condition of an entity at a given point in time or as of a given date. Please take note of the phrase as of a given date. The heading of a financial statement consists of 3 lines: the name of the company, the name of the financial statement, and the date. The date of the statement of financial position must be as of a given date. It must be dated, let's say, as of December 31, 2023, as of June 30, 2024, or as at December 31, 2024, or simply just December 31, 2024. We must not date the statement of financial position for a period of time, like for the year ended December 31, 2024. It must be dated as of a given date, not for a period of time. Please remember that. If a medical report shows the physical condition of a person at a given point in time, the statement of financial position shows the financial condition of an entity as of a given date. If the medical report reveals how healthy the person is, the statement of financial position tells us how rich or how wealthy the entity is. There are 3 elements which we can find in the statement of financial position. One of those is the assets. In layman's term, an asset is anything of value owned by an entity. We see here 2 requirements for something to be considered as an asset of a company or even of a person. First, it must be owned by the entity. And second, it must be something of value. So even if, let's say, you own something, if it does not have value to you, you cannot consider it as your asset. For example, there are waste materials in your garbage can. You own the trash or the waste materials, but can you say that those are your assets? Definitely not. That's why you place them in the garbage bin. You intend to throw them away. You don't consider them as your assets. Of course, for someone else, your trash may be considered an asset. As the saying goes, one man's trash is another man's treasure. But for you, whatever you have thrown in your garbage can is not your asset. Because for you, it does not have value. The question is, when can we say that something is of value? When it is expected to provide future benefits to the owner. When it has the potential to produce economic benefits. In accounting parlance, asset is defined as a present economic resource controlled by an entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits. Examples of assets include cash, accounts receivable, merchandise inventory, office supplies, land, building, and equipment. Assets are classified in the statement of financial position into current or short-term and non-current or long-term. Current assets or short-term assets are basically those which are reasonably expected to be realized in cash or sold or consumed within 1 year from the reporting date or within the normal operating cycle, whichever is longer. Now, what is a normal operating cycle? For a merchandising or trading entity, operating cycle is the average period of time that it takes to acquire merchandise inventory, sell the inventory, and ultimately collect the cash from customers. For a manufacturing business, the operating cycle is the period of time from the acquisition of raw materials for conversion into finished products until the collection of cash from the sale of those finished products. When an entity's normal operating cycle cannot be clearly identified, it is assumed to be 1 year. This is somehow due to the fact that, as you learned earlier, the basic accounting period is 1 year. Needless to say, assets which cannot be classified as current are shown in the statement of financial position as non-current or long-term assets. Cash, accounts receivable, merchandise inventory, and office supplies are some of the current assets because they are expected to be used or converted into cash within 1 year or within the normal operating cycle, whichever is longer. While land, building, and equipment are without a doubt non-current assets because they are expected to be used for quite a long period of time, definitely longer than the normal operating cycle or 1 year. Also found in the statement of financial position are the liabilities, the obligations, payables, or debts owed by an entity. Please take note of the difference between own and owe. Assets are owned. Liabilities are owed. When I tell you I owe you $100, it means that I have a liability to you in the amount of $100. Liability is formally defined in accounting as a present obligation of an entity to transfer economic resource as a result of past events. An obligation is a duty or responsibility that the entity has no practical ability to avoid. When we talk about liabilities, two parties are involved: the debtor and the creditor. The debtor is the one who owes something to another, or the one who has the obligation to transfer economic resource. Remember, liability is also known as debt. That's why the entity who has the liability is known as the debtor. The creditor, on the other hand, is the one who is entitled to receive the economic resource from the debtor. Just like the assets, liabilities are either current or non-current. Current liabilities are those which are reasonably expected to be paid in cash or to be settled within the entity's normal operating cycle or within 1 year from the reporting date, whichever is longer. Of course, those liabilities which cannot be considered as current should be classified as non-current or long-term liabilities. The reporting date referred to here, by the way, is the date of the statement of financial position. Account names which are considered liabilities include accounts payable, notes payable, and loans payable. What's the difference between accounts payable and note payable? Accounts payable is used when an entity purchases goods or receives service in the ordinary course of business without making a written promise to pay. Let it be clear though that an entity may use another specific liability account instead of accounts payable for the receipt of a particular service like rent payable and utilities payable. Anyway, again, accounts payable is used for the purchase of goods or receipt of service without making a written promise to pay. If the entity issued a written promise to pay, known as promissory note, the account name note payable or notes payable is used. How about the difference between accounts payable and loans payable? In accounts payable, what the entity received for which it must pay in the future is service or products, while in loans payable, the entity received cash, or in other words, the entity borrowed money from a lender. Now, you may want to ask, if accounts payable is the liability which is recorded when the entity received a product or service without making cash payment, yet loan payable is used when it received cash or borrowed money, how about note payable? What should the entity receive so that we can record the liability as notes payable? The answer is we use notes payable regardless of whether what was received is product, service, or money, as long as the entity made a written promise, as long as it issued a promissory note to the supplier or lender. The asset and liability accounts I've discussed so far are just some examples. There are many more, which you will encounter in due time.